All right, I think we can start. Hi everyone, welcome to our APAC webinar. My name is Serena and sending you regards from a hot and scorching Singapore. Joining me today are my colleagues, who are some of our most experienced analysts here in Vortexa. So we have David, our chief economist, Emma, who leads our APAC China Market Analyst, Roslan, who is our senior freight analyst, and Ioannis, who is our senior freight analyst. Some housekeeping rules before we start. This will be about a 30-minute presentation followed by Q&A. So if you have any questions for us, please pop it into the Q&A box and we will answer them. Rest assured that your questions will be kept anonymous. Also, a copy of the slides and recording will be made available to you after the session.
Yeah, hello, thank you. Sorry, we have a little bit of connection issues. I hope it's better now on my side. So let's start right away with what we're seeing in terms of OPEC supplies to the market. Generally speaking, crude supplies are not high. I will come back to that from a global perspective, but evidently OPEC is not doing much or anything at this point of time to change this situation. So you can see on the left-hand side, total OPEC plus seaborne crude and condensate exports. Essentially, since having staged quite some comeback in October last year, the developments have been flat, perhaps even trending to the downside, and that would type of resume a trend that has started already sometime late 2018, where OPEC supplies have come down steadily over time, and that's actually, if you look at the scale, that's quite significant volumes we have lost. On the right-hand chart, you can see some details. An interesting detail is definitely as well that the two, so to say, key members with supposedly holding spare capacity, Saudi Arabia and UAE, in the bars, they also have not really increased their exports ever since autumn last year. So basically they are producing, or they are supplying stable volumes to the market, but they are not increasing their exports, and probably the little bit of spare capacity they have left, which is probably much less than most of the market participants think. They want to keep that for some real potential outages, so to say, down the line. Let's move on to the next slide. So now what we have seen over the last couple of weeks, essentially type of the last 2 months, is somewhat surprising and worrying crude stock builds. So our global data covering more than 110 countries of onshore crude inventory data saw builds materializing most of the time over the last 2 months. On the left-hand chart, you see that it's a 4-week average chart. So basically, over the last 5 weeks, we had builds of more than 2 million barrels per day on a global level. Of course, this is driven to quite some extent by China, as can be seen in the right-hand chart in the yellow line. But nevertheless, the rest of the world is also currently seeing the highest stock levels so far this year. So again, this is something that does not speak for any real tightness in the market, at least not in the crude market. So evidently, and that's also shown by the refined product crack levels we have observed over the last couple of months, evidently the problem the global oil market faces at this point of time are the capacity limitations on the refining side, and that's something also OPEC countries are explicitly pointing towards a little bit in an excuse. Let's move on to the next slide, please. So let's talk a little bit about somehow the #1 question in the oil market, that is Russian oil exports. Even though the reality is basically that Russian oil continues to flow. Of course, it doesn't flow, how to say, completely without hiccups and difficulties, but it flows altogether, and in particularly the crude oil is continuing to flow. We focus here on these charts on the European side of exports, and that's simply because that's where the hiccup are. The crude exports to the Asian side, they are at pretty high level as well right now, and there are also certain issues with South Korea and Japan, for example, are scaling back their imports, but China is coming in to take over these barrels. And the real, basically, question marks, hiccups are on the European side, specifically on the Baltic and the Black Sea. So on the left-hand chart, you can see that we have a strong increase actually in crude exports. And perhaps before I talk more about that, let's have a look on the right-hand chart. There we see clean product exports. And on that chart, you can see that the volumes have come down somewhat as of March, April. That is particularly on the naphtha side of things. And the other product, my colleague Roslan will talk in a moment, that has seen clear cuts in exports is fuel oil. And basically the inability, especially March, April, but still ongoing, of Russian exporters to place their naphtha and their fuel oil is forcing refining run cuts in Russia. And that is basically the key reason why exports of crude towards the European market are actually increasing rather than declining. And we have here about something like 500,000 to 600,000 barrels per day more than usual over the last couple of months. It is important, of course, to raise the question, where is all this oil going to? And you can see on the left-hand chart that there is this big green area coming up. So about 1 million barrels per day is moving to Asia, especially India and China. Sri Lanka has recently joined as an additional destination, but so far otherwise pretty much everything goes to these two big countries. But you can also see that all the other bars down there, the bluish and yellow ones, they are actually increasing. So these are the exports towards Europe. So within Europe, we see a basically divided market. The Baltic and the EU continent, the two bars at the bottom, you can see that importers in that area, they have cut back their purchases drastically by up to 1 million barrels per day relative to peak levels last year. But the Mediterranean buyers and also the Black Sea buyers, they are more on the opportunistic side and they're taking more oil rather than less. And actually you can see that it looks like that the Asian share may even decrease a little bit. Now, let me come in at this point of time with the latest news on the European sanctions, the next package, the 6th round. It looks like that we're getting a decision now. It will include seaborne exports only, not the pipeline exports. However, the two big importers of pipe crude, Germany and Poland, have anyway said that they will cut back their Russian, or they will stop their Russian imports by the end of the year. So essentially, it's only about the relative small countries of Hungary, Slovakia, and Czech Republic. Together, these three countries so far this year took less than 300,000 barrels per day. So that will be exempted, and then there will be exemption for Bulgaria, it looks like. That's roughly about 100,000 barrels per day. Even for this month, they have taken more. So the overall volumes that will be exempted are not particularly big, but the more important aspect at this point of time is simply that all these new sanctions, also on the oil products, they will only come into force at the earliest towards the end of the year for products, actually rather early next year. So even for the key product diesel, the next winter season, probably there may still be imports going on, at least in the early part of the winter. So there is, I should mention also the ban on providing insurance for third-party shipments. So for example, the shipments to Asia, that will come as well, but it has also been postponed basically with a 6-month period now ahead of adoption. So what all that means is that over the next couple of months, over the peak summer season in particularly, there will not really be any limitation on Russian exports, and it may even go up, as the latest trend here anyway show on the crude and clean product side. Against this backdrop, I think it's very, very unlikely that we will see at least not further production shut-ins, but in reality, I think Russia may bring back some of its production. It has evidently shut in over April and May. So this calls of up to 3 million barrels per day from the IEA, that will not materialize. Now, passing on to the bottom of the barrel and to Roslan for some updates on the fuel oil market.
Thank you very much, David. So unlike Russian crude oil and gas oil flows that continue to flow to Europe, these two charts show clearly how Russia, the world's largest fuel oil exporter, is shifting its fuel oil exports away from the Western markets, which is the left-hand side chart, towards east of Suez markets, the right-hand side chart. A closer look shows that within Asia, it's Singapore and India that are importing more volumes of Russian fuel oil over the past couple of months, while in the Middle East, it's Saudi Arabia and the UAE. And this in turn has freed up more Middle Eastern fuel oil barrels for export to places like Asia and for a short time to the US as well. These redirected flows have hammered high sulfur fuel oil prices down from their recent highs in April, which had been boosted by tight supply and to some extent the contamination issue here in Singapore that we had, as well as strong demand, as the next slide will show. Thank you. So on the left chart, we can see there's a sharp rise in high sulfur fuel oil consumption for use in power generation by select Asian countries. We have an overlay of the high sulfur crack on top. Combined imports into these countries climbed to a near 4-year high in April, and then again in May, which helped push high sulfur fuel oil cracks to multi-year highs in April. But then as Russian supply began to seep in and stocks were replenished, high sulfur prices collapsed, narrowing the backwardated market structure and flipping cracks and cargo premiums into discounts recently. And most interestingly, the front month 380 high sulfur fuel oil east-west arbitrage spread has also flipped into a rare discount recently. And this, I think, illustrates how Asia is well supplied in terms of HSFO, while Northwest Europe is not, thanks to these changing Russian flows. By contrast, however, the VLSFO market has been surging, with cracks hitting record highs yesterday on increasingly tight supply and steady demand, which is expected to last well into Q3. This is a result of low Western arbitrage inflows into Singapore hub, which is the right-hand side chart, due to tight Western supply amid continued strength in the gas oil cracks, as well as steep backwardation, which discourages arbitrage flows.
Okay, thank you, Roslan. Let's now move on the shipping developments of the crude tanker market, and let's start to see what is happening with the VLCCs. So after a short-lived spike during the start of April, VLCC rates have tumbled, losing around a fifth of their value on the Middle East to East Asia, or the TD3C route. And the main drivers for the sulfur lie on both the importing and the exporting side. As David said previously, OPEC crude exports have dropped, and the decline is led by the Middle Eastern crude exports. We've also seen this limitation of the refinery capacity, and at the same time, the overall Chinese purchasing activity has also been reduced significantly over the course of 2022. Now, this as a result, what it has created, so a portion of VLCCs has repositioned towards the Atlantic basin, where flows have displayed actually a stronger performance, with Europe attempting to find replacement of Russian barrels. And so we have seen stronger employment of VLCCs in the WAF to Europe, US Gulf to Latin to Europe routes, and flows out of Russia. But the current trade developments that support VLCC demand in the West are not substantial enough to offset the losses stemming from the poor Chinese activity. And this has triggered an overall drop, actually, in VLCC ton-mile demand. At the same time, indicators like fixtures or the fact that the trading houses have started cutting down Russian oil purchases signal that this activity out of the West will not remain as strong going forward. And this makes a rebound of crude demand from China a necessary precondition, if you may, for a freight rate recovery on the VLCC market. Now, on the other hand, and looking at the chart on the right, Russia have had a considerable effect on Aframaxes. As we can see from the blue area chart, Russian crude on water is on an upward trajectory post-invasion, and this actually creates a question as to whether this increase is triggered because oil stays on water, and if there is an increase in floating storage, or is it because Russian crude barrels travel to further destinations. Looking now at the Aframax ton miles, so the yellow line for Russian crude and more specifically Urals, we get our answer, which is the latter, as this increase comes mostly for volumes on Aframaxes heading towards India and East Asia, a development that was not observed before the invasion. And unlike VLCCs, this development of rerouting the Russian crude has supported overall Aframax ton miles, which are on par with pre-pandemic levels. We can move to the next slide and talking about ton miles. So taking a bigger picture stance, and by looking, having a quick glance at both graphs, we can see that there is a clear divergence between the crude and the clean tanker demand by looking at the ton miles and comparing them with the pre-pandemic levels. And this divergence also is in tandem with the development of the crude and clean trade, respectively. So we have already touched up on the developments on the crude side. So now I would like to focus more on the CPP side, where high product cracks and decreasing clean inventories worldwide have painted a strong demand picture. And as we can see from the chart on the right, clean volumes have increased quarter on quarter, but have slightly lagged from pre-pandemic volumes. And similarly, ton miles of clean tankers are up quarter on quarter by around 4%, which is supported mostly by MR tankers. And especially in April, this increase in MR tanker was a result of a strong clean flows and strong activity in the west of Suez. However, also development in the Eastern Hemisphere have also played an important role in this resurgence of the global CPP ton miles. But we will zoom in on these details at a later stage of the webinar. But first, we will move to the developments of the flow side of things. So back to you, David.
Yeah, so what we see on the left-hand chart is global refined product liftings in the 3 bars for the transportation fuels. So that's all liftings, irrespective of whether it will be exports or not. And what you can see is how strong the uptick has been over the last couple of months already, but especially over May. So the refining system is now clearly reacting to this very strong product cracks, has at least temporarily cooled cracks a little bit, especially on the middle distillate side. And nevertheless, if we look at the right-hand chart, we see that stock levels at key hubs are still very low for middle distillates, the light blue line. And for light distillates, it's a mixed picture. I come back to naphtha later on, so that's the weaker product. The stocks will be higher, but generally speaking, the stock coverage, for example, also in the US, is very low. What we can conclude also from the left-hand chart by looking at the red line, so that's basically all other products, refined products, not the transportation fuels, then you see there that basically exports or liftings of those products, to be correct, are trending downwards pretty much already over the course of the year, but also in May. So what this indicates is that refiners are really making every effort at this point of time to produce as much diesel, as much gasoline as possible. But with the overall capacity limitations, that may still not enough to really cool the market. And the inflation issue we have is one still at this point of time, and we may well continue to so. It's really one on the product side on top of this baseline of 110 or whatever dollars per barrel of the crude side. Yeah, so this refining limitations will remain an issue, and the IEA's call that global crude runs in August will be 4.7 million barrels per day higher than in April. We will see whether that will become feasible. Yeah, we see outages, of course, all the time as well. Surely we have come out largely out of refining maintenance. There is still a little bit to go in Asia, but overall, it looks very much that we will continue to see these limitations. Let's see whether we can hear Serena.
David, can you hear me all right?
Yes, sounds good.
Awesome. I am going to try to keep my camera off. Hopefully, if I don't sound good, David, give me a shout. So in this slide, what we're seeing is Asia's refinery margins. And what's interesting here is that refinery margins for both the simple as well as the complex refinery configurations have actually risen to one of the highest points over the last 2 years. Now, from a product cracks perspective, this is very much driven by diesel cracks in the first quarter of this year, but it has now been surpassed by gasoline cracks because of the uptick in gasoline demand, especially from the US, as well as tight supplies globally. Now, from a feedstock perspective, high crude prices have not been favorable for the refiners. But with oil prices really climbing, what we're hearing in the market is that several refiners are looking to extend their term contracts with the Middle East crude suppliers in order to reduce the exposure to the volatility in the market. Just to confirm that you guys can still hear me?
Yes, everything fine.
Right. Now, just to continue, now, an often missing piece that people do not really consider much is actually the dirty tanker rates, because that actually affects the feedstock costs. And for the Asian refiners, it is particularly important because the Asian refiners are heavily dependent on crude imports. And if you look on the chart on the right, VLCC rates have in fact been very favorable for the refiners, although it's not great news for the ship owners. But this has helped to keep a lead on the refiners' feedstock costs to support margins. As Ioannis mentioned, in the near term, we expect VLCC rates to remain cool, and this will help support refining margins. David, back to you. What are the key trends that you're seeing on Asia's crude and refined product imports?
Yeah, now I'm looking here a little bit at the negative side of things, so to say. So I did talk about the crude stock builds at the beginning, and just to answer one of the questions, this is exclusively on land floating roof storage. So the builds I've shown on the second slide, they do not include the additional oil at sea that was shown by the chart from Ioannis a couple of slides back. Of course, that's another factor. So there are many millions of 50, 60 million barrels of Russian crude that are on the water that would otherwise not have been on the water. That's another type of 1 million barrels per day stock build we've observed. And basically that means that the market is not getting this crude at this point of time. And nevertheless, it's not particularly tight. So the point I want to make with this slide here is that we evidently do already have repercussions of the high prices, repercussions of the supply chain issues, especially in China, and the COVID restrictions there. And one product, or the product to see this best on the right-hand chart, is naphtha. So you can see here petchem feedstock imports into Asia. The blue bars are naphtha, and you can see how drastically naphtha imports into Asia have come down over the last couple of months. So this is more than 400,000 barrels per day from the level late last year to the level recently. Chart shows a 3-month moving average, but it's a steady decline. And essentially we are back in terms of the naphtha import level to Asia to the lowest levels observed in 2016. Yeah, so that's many years how we have fallen back. And of course, partly the story is that there is a substitution and move towards LPG, but it's only partly the explanation, because this trend is really very sharp recently. And generally speaking, naphtha is often considered as a key indicator for the economic health, for economic development, as an early indicator for a recession in this case. Now, the other point I want to make on the left-hand chart is that we do have these crude stock builds, even though global crude liftings, as I mentioned earlier on, they're actually not trending up. So if you look at the red line in the left-hand chart, you see that the biggest crude liftings have happened late last year. And ever since, they are rather trending down than up. And especially in March, they have been particularly low. That would be the barrels that would currently roughly arrive on the global average in May. So in spite of this low liftings, there have been stock builds. And again, if we look at crude imports on the Asian side, the solid blue line, you can see, yes, we are just about back to the 2019 level. But China plays a crucial role in that. Other Asian countries are actually below that level. Yeah, being just at this 2019 level still means this massive stock builds of 1.2 million barrels per day it was for Asian countries over the last 9 weeks, or the last 2 months, essentially. And again, all this is happening even for product imports into Asia. The dotted line, they are significantly below the 2019 levels over the last couple of months. So that's a little bit the warning signal I want to give at this point of time, that there are clear signs that the market is significantly slowing down. Serena will try in a moment to give us a little bit of a more upbeat look at the market.
Thanks, David. So undeniably, the petchems demand has been pretty disappointing. But the good news is that if we focus our attention to look at the Asia transport fuel demand, here on the left chart, we break them down into Northeast Asia, India, as well as Southeast Asia. So we see that demand on the transportation fuels has seen a steady recovery since late last year, and the momentum has actually continued into this year. But rising inflation poses one of the key downside risks to this demand recovery. And we're not only talking here about fuel prices, but we're talking across the general lifestyle of people, from basic goods all the way to services of everyday life. And what the governments are trying to do is to alleviate this price pressure by increasing subsidies and capping the retail prices. So for example, in India, the government has recently cut the excise duty on gasoline as well as diesel retail prices. In Indonesia and South Korea, we understand that the government is also increasing its subsidies on fuels. But the sustainability of Asia's refining margins is not only dependent on the domestic demand as well as margins. What we see on the right chart, in fact, is that Asia refiners are very much dependent on exports to other regions. And in fact, close to 50% of Asia's clean product loadings, here we're talking about gasoline, jet, as well as diesel, are exported to countries outside of Asia. So predominantly Oceania, Australia, New Zealand, the US, Europe, as well as Africa. And the truth is that the global refining capacity is really, really tight because of refinery closures over the last few years. And Asia will continue to remain as the marginal supplier. And we expect that this trend will continue. And in fact, it could potentially accelerate once the EU ban on Russian oil imports kicks in. So with that, I think it's good time for us to dive into how the refiners in each of Asia's countries are doing. So we'll start off with Emma. Emma, would you mind sharing with us what's happening in China?
Sure. A recent hot topic is Russian crude flows to China, especially when energy prices remain elevated and China is looking for a recovery from a COVID recession. While Western countries are turning away from Russian oil, Chinese refiners are quietly accepting these heavily discounted barrels. And let's take a closer look at how this is reforming China's refining feedstock basket. The left-hand side chart shows China's monthly imports from Russian Far East. We can see that the SIBO blend, which is one of Chinese refiners' favorite crude grades, has picked up to all-time high in May. And since other traditional buyers, such as Japan and South Korea, are pulling back, we expect the volume will remain robust going forward, as almost all the Russian Far East crude barrels will end up in China. This has also caused Aframax freight rate on the Khasawneh to China route, which is represented by the red line here, being tripling from the pre-war level, as many ship owners are reluctant to get involved in this shipment. As a result, an increasing number of Suezmax-sized vessels is employed, and recently we found that some VLCCs were also used in this short-haul shipments by SDS in Yuzu in order to shorten the Aframax leg. We've also noticed that some Aframax vessels that previously delivered sanctioned barrels on the Singapore to China route now turn to ship as bulk cargoes. Another reason for the traders to free up Aframax vessels is that more Urals blend cargoes are now carried on Aframax-sized vessels, which were previously carried by VLCCs by SDS in Skol or Rotterdam from Russia Baltic to Asia. The right-hand side chart shows that Urals arrivals to China have also picked up to multi-year high in May, and more vessels are signaling waypoints towards Asia in June, which were ultimately taken by Chinese buyers via Singapore. These ample discounted Urals have become a strong competitor to other discounted barrels for Chinese independent refiners in particular. The two lines in the right-hand side chart represent Iranian and Venezuelan barrels discharged into China every month. We can see that their main figures are well below their 18-month averages, which were 600 to 800 kbd each. And there are a large number of tankers floating offshore Chinese ports, which represented by the dot lines here, as the refiners' appetite is still limited and they prioritize to take in Russia barrels. Next slide, please. So besides a slowing down in Iranian or Venezuelan cargoes discharge, there are more tankers carrying such oils floating in the high sea to the east of Singapore, waiting for orders from Chinese buyers. The left-hand side screenshot was taken from our live map a few days ago, when we captured at least 15 such floating tankers. Now, all these discounted oil cargoes blow a heavy headwind to normal spot crude grades, especially to the ones from Africa, Brazil, and Norway, besides some Middle Eastern outright barrels. The outright, the right-hand side chart basically shows the divergent trends of these barrels into China. Next one, please. Now, let's take a look at China's overall crude imports. China's intake this year are well below the levels seen a year ago, even including the cheap barrels. This is because the refiners have largely cut crude purchases this year and maintained lower refining run rates, especially for refiners in Shandong and Zhejiang provinces, while fuel demand and refining activities have suffered from COVID breakout and long-time lockdowns. The unplanned refining run cuts, together with seasonal turnaround, have resulted in week-on-week rise in China's onshore crude inventories since April, which have now climbed to the highest level since August 2021, and may extend gains in coming weeks. However, if we take a closer look, Shandong's crude stock build, which is shown by the green line in the right-hand side chart, is seen to slow down last week. This is because refining operating is gradually recovering in that region, while fresh crude imports are still quite low, remain at lower edge of 12-month average after the independent refiners cut April loading purchase. Next one, please. So if we combine the crude inventory changes and net crude imports, we can see that China's implied crude consumption have dropped to a 2-year nadir in April, and that remained quite low as well in May. And even though the refiners were facing a product glut in recent months, the right-hand side chart shows that China's clean product exports were largely kept since second half of last year due to quota limitation, while exports have picked up strongly in April and May on the back of COVID lockdown-related clean fuel surplus and surging Asian crack margins against cooling domestic margins. We think China will probably issue additional export quotas to supplement the 13 million tons issued in the first batch, according to industry sources. Based on our shipping data, Chinese refiners have only utilized about 10 million tons of 2022 quotas so far. So with the additional quotas, they may increase exports, especially on gasoline and jet barrels in June. It's worth to mention that China has shifted its guidelines to rationalize refining capacities last year by reducing crude import quotas as well as product export quotas. It's quite unlikely that the quotas will get back to 2019 levels, even though the country aims to boost economy this year. So that means that the remaining batches of quotas for the year will remain kept. And after the product glut issue is solved and domestic demand is hopefully recovered in Q3, China's product export will cool down. Next one, please.
Thanks, Emma. Now, if we contrast what's happening in China with India, Indian refiners have been keeping their runs really strong because of high domestic as well as export margins. They have even postponed maintenance in March and April to keep their refinery margins strong. Now, in this slide, what we have done is to derive the individual refineries' implied refinery runs by using our crude import volumes at the refinery level and netting off the inventory change. And that allows us to assess the current refinery runs even before the customs data are being published. Through benchmarking our historical data with customs, what we see is that there is a strong correlation between our data and customs. And the message over here is that Indian public sector refiners, which is the chart on the right, will continue to be very much dependent on domestic demand, which is in turn potentially facing downside risk from rising inflation, and that's very much dependent on the Indian government to keep prices under control. On the other hand, the export-oriented private refiners, which is the chart on the right, will likely ride on the strong demand from both east and west of Suez, as well as domestic margins, to continue to keep their refinery runs strong. Now, if we look at Northeast Asia refiners, what's interesting is that they have balance between the strong transportational fuel as well as the weak petchems margins. So on the one hand, we see Taiwan, which is the line in light blue, ramping up its refinery runs strongly after its maintenance, and it has in turn been reflected in its strong refined product exports. But on the other hand, we see South Korea's refinery runs, which, while healthy, are still shy of the historical highs owing to a fire incident on Onsan's refinery, as well as more particularly dismal cracker margins. While in Japan, at least 250 KBD of the refinery capacity has been shut down because of maintenance, which has also put a cap on upsides to refinery runs. Well, with the tight gasoline and middle distillate supplies both regionally and in the West, we expect that exports from Northeast Asia's refineries will continue to remain robust in the near term. Hey, Ioannis, isn't this definitely good news for the clean tanker market?
It is indeed, Serena. Thank you. And let's see how indeed the clean tanker industry has unfolded, especially on MRs. Towards the west, we've seen this surge in flows for MR tankers for various reasons. We've seen strong North American to LATAM clean flows on the back of strong diesel and gasoline demand, higher agricultural demand. and slowly recovering economic activity and mobility. At the same time, we've seen North America to Europe flows held at seasonal levels as the US contributed to this diversification of European supply. And finally, we had strong gasoline demand out of West Africa, which eventually subsided, but it was followed by strong demand for the Europe to PAD 1 gasoline flows. So this increasing action in the West, what actually created, as we saw with VLCCs, it has created a continuous migration of MRs towards the West. And this migration had a knock-on effect and has alleviated the vessel supply side in the East, which has partly contributed to this rally in Pacific earnings, where, as we can see from the chart, it followed the rally that occurred in the West, and Pacific MRH reached 2-year highs at the beginning of May, and this almost tripled shipowners' earnings in a window of a month. But it's not only the supply side that contributed to this increase, but it's also the demand side, which we can see on the next slide. Thank you. So yes, we've seen that clean ton miles for MRs out of the east of Suez have been on an upward trajectory, supported by increasing diesel flows, especially out of China and heading to countries like Australia and South Africa. But also in total, this MR utilization increase in a global scale, it also reflects the need for carrying products urgently amid shortages. And the most suitable vessel class to do this is the flexible MRs. However, another observation that we have observed is that diesel volumes on MRs have plateaued in recent weeks, and partly had to do with a small decline that we saw on diesel cracks. And this brought freight rates in the Pacific down. We see rates in routes like South Korea to Singapore or Singapore to Japan that have declined by 40% and 20% from their peaks, respectively. But it also has to do with the supply side, as we're slowly seeing like MR availability being on an increasing trend after a yearly low reached in mid-April, which at the same time could lead to a further drop in rates in the short run. And apart from this, weak naphtha demand from the Far East has caused LRs to find employments in away from the traditional routes of TC1 or TC5, which is the Middle East to East Asia routes, and has led to a cannibalization of MR routes, with the latter increasing their market share at their expense. Yeah, without further ado, I'll pass on to you, David, for the conclusion.
Yes, so I think we have seen a lot of interesting trends happening in the market. There are some clear aspects, which is that the product market is way stronger than the crude market, so the crude inventory builds are a concern. Of course, however, just to add here, we do see right now a start of some competition for West African barrels, for the sweet barrels in particular. So there are now signs that the summer demand and the Chinese comeback basically are starting to come in. Generally speaking, also trying to answer some of the open questions here. We do think that the high prices are affecting demand all around the world. I think the indications in the US, in Europe, in Asia. However, the demand is still strong enough and is very likely to stay strong enough. And there is this upside from China coming back out of the COVID restrictions, that the market will remain very tight going forward. So it will be a tight market at a lower level than originally thought. There are these big reshuffles going on of Russian oil, and just to answer here also a couple of questions. The one crucial element that they didn't mention is the sanctions that are already in place prohibiting basically the non-essential trade in Russian commodities altogether. And this has basically kicked out the major trading company of dealing with Russian oil. And that means has a couple of implications. It makes, of course, these deals, any deal to Asia, more complicated. And then the market simply had no time to look at that much at fuel oil and at naphtha, which is simply not as important. The diesel anyway stays in Europe. And this lack of the major trading companies is also probably the reason why there are barely any VLCCs of Urals from Europe to Asia. For that, you need really the deep pockets, and you need to arrange with a couple of buyers and sellers potentially. So we're seeing rather the Aframaxes because it's one-to-one deals between the Russian seller and the Asian buyer in quite some of the cases. Yeah, so Asian margins will remain strong. The clean tanker market will continue to benefit from that as well. I would add one thing, it's a little bit on the speculative side, but I would say the MR rates are the stars, because in this market we have tightness everywhere, left and right, and it's a prompt tightness. So it needs basically a quick, regularly quick shipments to ease some of those tightness, and that simply makes most sense on the you know, from one ocean to the next ocean on the MR tankers, again, because it's one seller, one buyer, and that is perhaps the easiest to set up in the short term. So MR rates will remain strong, clean tanker rates will remain strong. There may be a little bit of uptick for the dirty tankers, also as some of the fleet is bound with the much longer Russian exports, but overall the dirty fleet is simply way too oversupplied in order to have a lot of upside down the line. And then, yeah, I would like to conclude. Many thanks. As said, the recording of this presentation will be made available to the participants. Yeah, thank you for all the questions. Thank you for joining us in such big numbers, and looking forward to see you next time.